Hello everyone, welcome back to the channel. Today's video is going to be my 2023 introductory guide to exchange traded funds for beginners. This is the third installment in my series of 2023 guides that I'm releasing to provide you with clear, concise and reliable information that will set you up for investing success in the decades to come. In this third guide, we're going to discuss what exchange traded funds are, why exchange traded funds are the best stock market investment, how you profit from owning exchange traded funds, the best exchange traded funds for beginners, and how you go about investing in exchange traded funds. Alright, so what are exchange traded funds? Exchange traded funds, better known as ETFs, are a type of investment fund. An investment fund is a company whose business involves buying and selling financial assets for the benefit of the company's shareholders. You become an ETF shareholder by buying the ETF shares on the stock market. It's called an exchange traded fund because shares in the fund are traded on a stock exchange. When you buy a share in an ETF, you become entitled to A, the net assets of the ETF, and B, the future earnings of the ETF. Those of you who have watched the first installment of this series will remember that. So I don't want you to think of ETFs as being anything else but a company. It's a company whose business is to buy and sell financial assets. And when you invest in that company, you become entitled to a portion of the financial assets which the company owns. There are two main types of ETFs: actively managed ETFs and passively managed ETFs. Whether or not an ETF is actively or passively managed will determine what financial assets the company trades and how it trades them. If an ETF is actively managed, that means there's a team of people who are actively making decisions about what the ETF should invest in. If an ETF is passively managed, that means the ETF is investing in financial assets directly in accordance with a specified financial index. A financial index is a tool which is used to measure the performance of a collection of financial assets. Financial indexes are provided by various companies around the globe, and passively managed ETFs use them to determine what the ETF will invest in. As we've only been talking about stock market investing in this series, it only makes sense that we talk about equity ETFs. That is, ETFs which invest in company stocks. If the equity ETF is an actively managed ETF, there will be a team of investment professionals deciding what stocks the ETF will buy and sell. If the equity ETF is a passively managed ETF, then the ETF will buy and sell stocks in accordance with a particular stock market index. For example, the S&P 500 is a stock market index which measures the performance of the top 500 companies in the United States. So an S&P 500 ETF would buy and sell stocks in accordance with the S&P 500 index. Again, no investment professionals at the wheel making decisions. So why are ETFs the best stock market investment? Well, we can actually reframe that question to why are passively managed ETFs the best stock market investment? You see, there is decades worth of data which tells us that over long periods of time, passively managed ETFs perform better than actively managed ETFs. And there are two main reasons why that is. The first reason is that it's cheaper for investors to own passively managed ETFs. This is because the ETF does not have to pay a team of investment professionals for their services. Remember, the passively managed ETF is making investment decisions in accordance with a financial index, which requires no active decision making from investment professionals. That saves investors a lot of money in fees. The second reason is that the so-called investment professionals find it very difficult to perform better than the financial index. In other words, over long periods of time, it's incredibly unlikely that any individual can consistently pick the best financial assets to invest in. More specifically, it's very difficult to actively pick the financial assets which will result in better returns than a comparable financial index over 20 or 30 years. In fact, this is also the reason why passively managed ETFs are the best stock market investment, full stop. If the investment professionals can't pick the best stocks to invest in, how will you? The fact that the data supports passive investment strategies over active investment strategies means that there's very little justification for you investing in anything else other than passively managed ETFs. Alright, so we've talked about what ETFs are and why passively managed ETFs are the best stock market investment. But how do you actually profit from owning ETFs? If you watched the first episode of this series, you'll know that there are two ways of making money on the stock market: capital appreciation appreciation and dividends. Capital appreciation refers to an increase in the value of your shares. Simply put, the value of your shares has increased above the price that you paid to buy those shares in the first place. A dividend is a payment made to you by the company in which you own shares as a reward for continuing to own those shares. Those same two money-making methods are equally as applicable to ETFs, but let's talk about how the value of your ETF shares could increase and in what scenario your ETF would pay you a dividend. Generally speaking, the price of one share in an ETF at any given point in time will be equal to the net asset value or NAV per share of the fund. NAV per share simply refers to the total assets of the ETF minus the total liabilities of the ETF divided by the total number of issued shares in the ETF. In other words, how much net assets each shareholder would be entitled to in the event of the ETF's closure. If that sounds familiar to book value per share from episode 1, that's because it is. But unlike book value per share, which typically represents the minimum price of one share in a given company, the NAV per share of an ETF typically represents the market price of one share in the ETF. Because of how ETFs operate under the hood, any discrepancies between the NAV per share and the market price of one share in the ETF are quickly closed. So with that understanding, the value of your ETF shares would increase when the value of the ETF's assets increase and the ETF's liabilities either stay the same, decrease, or increase by a smaller proportionate amount to the increase in assets. Remember, an equity ETF would buy shares in other companies, so therefore the ETF's assets would increase when the value of the company stocks which the ETF owns also increases. So if you invested in an S&P 500 ETF, your shares would increase in value when, collectively, the change in value of all 500 stocks in the S&P 500 index was positive. Now, because the ETF is buying shares in other companies, the ETF is the shareholder in those companies, meaning when some or all of the companies choose to pay a dividend to their shareholders, the ETF will receive its proportionate share of the total dividend. But you are a shareholder in the ETF, so you have an entitlement to the dividends which the ETF earns from its investments. How the ETF chooses to reflect that entitlement is dependent on the ETF in question. When it comes to dividends, an ETF can either be an accumulating ETF or a distributing ETF. If the ETF is an accumulating ETF, it will take the dividends that it receives from its investments and it will reinvest them. In other words, it will buy more stocks with the dividends. If the ETF is a distributing ETF, it will pay out the dividends it receives to its shareholders, which includes you, meaning you'll receive a cash payment into your brokerage account and you can choose to do whatever you wish with that cash. So those are the two ways in which you profit from owning ETFs. With that being said, what are the best ETFs for beginners? It's a bit of a silly question in itself because the best ETFs for beginners will also very likely be the best ETFs for seasoned investors. And it's also entirely dependent on you as an individual and your personal circumstances. So instead of saying this is the best ETF for beginners, let's instead look at some of the characteristics which make a particular ETF a good choice. So when I'm evaluating ETFs to invest in, I look at a couple of things. The first thing I look at is the ETF holdings. The holdings of an ETF refers to what the ETF invests in. ETFs can invest in stocks, bonds, commodities, crypto, and much more. So it's important that you know what the ETF is investing in, because that's going to directly impact how successful that ETF investment ends up being. I exclusively invest in ETFs whose holdings reflect a major stock market index like the S&P 500 or the MSCI Europe Index. The next thing I look at is the total expense ratio of the ETF. This essentially tells you how expensive it is for you, the investor, to own shares in a given ETF. Remember, passively managed ETFs are going to charge much lower fees than actively managed ETFs because they don't have to pay for an expensive team of investment professionals to make decisions. Ideally, you want to invest in the ETF that charges the lowest total expense ratio while also offering you exposure to the financial assets that you're looking for. In other words, if you wanted to invest in an S&P 500 ETF, you'd likely go for the S&P 500 ETF that charged the lowest total expense ratio. But before pulling the trigger on an ETF purchase, I would look at some other factors. I'd make sure that the ETF was an accumulating ETF instead of a distributing ETF for dividends. That's because for me, it's more tax efficient to own accumulating ETFs. The Irish tax system would have me paying tax on the dividends I received from a distributing ETF. So to avoid that, I exclusively invest in accumulating ETFs. I'd also look at my brokerage platform to see if the broker offered any commission-free purchases of certain ETFs. This can be a great way to minimize the amount of fees that you're paying when investing. Speaking of brokerage platforms, let's talk about how you invest in ETFs. So if you watched the last episode in this series about brokerage accounts, you'll know that brokerage accounts are essentially our gateway to the stock market. We use brokerage accounts to invest in company stocks, and shares in ETFs are no different. You'll need to have a brokerage account in order to buy shares in ETFs. I mentioned that certain brokers offer commission-free purchases of shares in certain ETFs. The reason why I know that is because DeGiro, who is my broker of choice, does just that. They offer a selection of commission-free ETFs where you can buy shares at zero cost other than the cost of one share in the ETF. If you want to try out DeGiro for the purposes of investing in ETFs, you can do so for free using the link in the description of this video. Now, when it comes to finding ETFs on your brokerage platform, there's really two options. Option one is doing your research online to find an ETF that's best for you. Once found, you would then need to check whether your broker or another broker offers this ETF. If they do, happy days. If not, you'll need to find another ETF. Option two is to evaluate the ETFs that are available on your brokerage platform. You would select an ETF and then research it to see if it's a good fit for you. Essentially the opposite of the first option. If both of those options sound too complex, then you can check out the video popping up on screen now for inspiration. In that video, I show what ETFs I'm currently investing in, and I explain why I'm investing in them. So that's everything you really need to know about ETFs as a beginner. As I've said in previous videos, passively managed ETFs are great because they require virtually no time commitment on your part. You can simply automate your investments into them, and based on historical data, in 20 or 30 years time, you'll have generated very positive returns. This means less time spent in your brokerage account, less time spent researching investments, and more time spent doing the things that actually matter to you. In the next episode of this series, we're going to talk about an alternative investment to ETFs, which are dividend stocks. We'll talk about what dividend stocks are, how you find dividend stocks, why dividend stocks can be a great investment, dividend stock pitfalls to avoid, and much more. Don't miss it. So I hope you found this guide useful. If you did, you can show your support by leaving a like and subscribing to the channel if you haven't already. If you have any questions on anything that we covered in this video, please do not hesitate to leave a comment down below and I will answer your question to the best of my ability. Thanks very much for watching, and I'll see you in the next one. Cheers.